Hello, I'm Sherry Penner, Deloitte Private's tax leader for Canada. I am pleased to share with you the fourth in our series of videos addressing the federal government's proposals on tax planning using private corporations. In particular, this video will address potential changes to the taxation of investments held in a private corporation. Under the current rules, the effective tax rate for an individual earning income through a corporation once the net profits are distributed by means of a dividend should be almost the same as the effective tax rate for an individual earning a salary. However, Canadian individuals earning business income through a private corporation are able to defer personal tax on that income until it is paid out to an individual by way of a dividend. In contrast to an individual earning salary and being taxed immediately at the high personal tax rate, a business owner that reinvests profits through a corporation can generally benefit from the deferral of some tax, thereby retaining a larger amount of capital to invest. The July 18th proposals seek to eliminate this deferral of tax and the benefit it provides to corporate business owners. At this stage, the proposals regarding passive investments are only at a preliminary stage of development by the government. No draft legislation has been released, and the government is still seeking public consultation. In the proposals, Finance has presented two broad approaches that would be applicable on a prospective basis, implying that a number of transitional rules could be put in place. Under the first approach, any net profits earned through a private corporation that are not reinvested in assets used in an active business would be subject to an immediate additional refundable tax. The additional tax would bring the total corporate tax paid to the theoretical equivalent of the highest marginal rate of an individual, which is around 50%. In practice, this approach would basically eliminate the additional funds available to private corporations for reinvestment in passive holdings. This approach could also create cash flow issues where business assets are acquired in a subsequent year, because the recovery of any refundable tax would only be received after the business investment is made. Although included in the proposal document, the Department of Finance has indicated that this approach is not being seriously considered at this stage. Under the second approach, tax deferral would remain available at the corporate level. However, the portion of tax on investment income representing over 30% would no longer be refundable upon ultimate distribution to the shareholders. As a result, the effective tax rate on investment income earned through a corporation would increase to almost 75% when the income is distributed to individuals. These high effective tax rates could also be applicable to some business earnings if the corporation is considered to be a specified investment business. For example, a small incorporated car rental business could be subject to these high tax rates due to the passive nature of rental income and the rules about a limited number of employees in these circumstances. In effect, the second approach has less immediate cash flow impact at the corporate level, but increases the cumulative tax burden of the corporation and its shareholders overall. Furthermore, this approach would require the tracking of a number of tax pools and elections and would likely result in a significant increase in tax compliance costs. In addition to these two approaches to dealing with passive income earned in the corporation, the Department of Finance is also considering the elimination of additions to the capital dividend account for certain passive investment gains. This would significantly increase the effective tax rate on distributions to private company shareholders with respect to realized capital gains. Since these proposals have not been released as draft legislation, there are a number of open questions. For instance, would the proposed rules also apply to private corporations that are not Canadian controlled? And will existing passive investments be grandfathered? If you have current passive investments in a corporation or plan to accrue them in the near future, you may need to consider options around the payment of dividends and the recovery of refundable tax before any changes are implemented. However, given the uncertainty around nature and timing, we recommend that no action be taken until more specific information is released, including draft legislation. We also encourage you to discuss options with your Deloitte tax advisor to prepare for the potential change. I hope you found this summary valuable in understanding the proposed tax changes related to holding passive assets inside a private corporation. I encourage you to stay in touch with your Deloitte tax advisor regarding the status of these changes, as they will evolve over time. We look forward to sharing additional insight with you in the coming weeks and remain ready and able to help you navigate these changes.